You are listening to Uranium Spotlight on Tuesday, July 30th, 2024. Brought to you by Pure Point Uranium Group, your exploration partner in Canada's Athabasca Basin. Amidst surging uranium demand, Pure Point's continuous 2024 exploration across their vast portfolio, backed by industry giants, underscores their focus on the next major discovery. And now your host, Chris Frostad.
This week on Uranium Spotlight, the uranium sector shows a steady second quarter. Australia's Jabiluka mine dims, India opens up its nuclear sector, and Orano releases its half-year results. Last week, the uranium spot price dropped another $2 to close on Friday at $82 US per pound U3O8. In an update last week from Sprott, they outlined that during the last quarter, the uranium spot price had remained stable between $85 and $95 a pound, ending June at $85.34. Despite that drop in June, uranium miners bounced back in July, outperforming the commodity year to date. Kazakhstan, the world's largest uranium producer, announced a significant tax increase, reducing incentives to boost production. M&A activity is rising, highlighted by Paladin Energy's $833 million acquisition of fission uranium. Geopolitical instability in Niger continues to impact the market, with revoking mining rights for Orano and GoviEx uranium. Recent legislative developments in the U.S., including the ADVANCE Act and the Prohibiting Russian Uranium Imports Act, support nuclear energy, potentially boosting uranium demand. These acts promote domestic nuclear technology investment and cut ties with Russian uranium, reinforcing the market's strength. Despite current market softness, uranium's long-term fundamentals remain robust, driven by nuclear power plant restarts, new builds, and a widening supply deficit. The supply-demand gap is expected to grow, with 2040 demand projected at 338 million pounds, necessitating a doubling of current mine supply. Overall, uranium and mining equities have outperformed other commodities over the past 5 years, reflecting a healthy market correction within a broader bullish cycle. With no significant new supply anticipated for several years, higher uranium prices are likely needed to meet future demands, suggesting continued market strength and potential for investment. The Jabiluka uranium deposit in Australia's Northern Territory has been closed to all mining and is now part of the Kakadu National Park. This deposit, previously home to the Ranger 1 and Ranger 3 open-pit mines, was being developed further by Energy Resources of Australia, or ERA, a subsidiary of Rio Tinto. However, the active development ceased after prolonged protests by the local Mirror people and environmental groups. Jabiluka is estimated to hold 75 million pounds of uranium from the unmined resources below Ranger 3 open-pit mine, and undeveloped resources of 182 million pounds at Jabiluka 1 and 297 million pounds at Jabiluka 2. The Australian uranium market is thriving, with various players experiencing significant stock price increases as uranium prices have surged. The price peaked at over $100 a pound last year, compared to less than $30 a pound in 2020, and is now settled at around $85 a pound. Companies such as Boss Energy, Deep Yellow, and Bannerman have all seen their valuations rise. Another notable development is Paladin Energy's recent purchase of a controlling share in Fission Uranium Corp., a Canadian uranium company. If this acquisition passes Canadian regulatory approval, Paladin will become the third largest uranium producer in the world, producing 10% of the world's uranium, just slightly less than giants Cameco and Kazatomprom. In contrast, ERA has not fared as well. None of its mines have produced uranium since 2021, due to a combination of developmental delays, low prices, and opposition from the Mirror people. Rio Tinto has been cautious about expanding mining operations, especially after the backlash they faced in 2020 when the expansion of an iron mine destroyed sacred rock shelters in Western Australia. To meet its supply commitments, ERA has been purchasing uranium from third parties, primarily mines in Kazakhstan. This strategy was profitable when uranium prices were low, as buyers were willing to pay premium for long-term supply security. However, with the recent price increase, it remains uncertain whether this approach will continue to be viable. With no operational mines capable of producing uranium concentrate, ERA faces a challenging period ahead, and its stock has declined following the closure of the Jabiluka deposit. The Indian government has, for the first time, allowed private corporations to invest in its nuclear sector. Until now, only state-owned utilities such as the Nuclear Power Corporation of India Limited, or NPCIL, have owned and operated all of India's reactors and managed their construction. However, several massive corporations, including Reliance, GMR Energy, and Tata, are now ready to take on the roles of reactor builders and operators. The government will likely continue in an ownership role. These corporations, which are substantial even by global standards, have extensive experience in major infrastructure projects such as airports, highways, and fossil fuel power generation. They're also involved in steel manufacturing, media operations, airlines, and automotive manufacturing, among other sectors. This move could lead to a significant influx of capital into India's nuclear energy sector over the next few years. Many infrastructure companies in India have been preparing technical teams in anticipation of this opportunity. The government has allowed private sector cooperation in three key areas of the nuclear energy sector: small reactors, research and development, and small modular reactors. According to government sources, 16 units of the pressurized heavy water reactor type have already been built. While India currently has no operational SMRs, there is a strong interest in this technology, which is already in use in China and Russia. SMRs can be factory-built and assembled on-site, reducing costs and construction time compared to traditional reactors. They can also provide dedicated power generation for heavy industry, which could be particularly appealing to Tata Group subsidiaries such as Tata Steel or Tata Automotive, the latter of which owns brands such as Jaguar and Land Rover. Framatome recently signed an agreement to supply fuel to a Slovakian utility operating two Russian-built VVER 1200 reactors. Traditionally, VVER reactors are fueled by Rosatom, the Russian state-owned corporation, or its subsidiary Tenex. However, since Russian invasion of Ukraine in February 2022, many reactor operators have sought to diversify their supply sources to ensure security. The first fuel rods for VVER reactors built by Western companies were manufactured by the American company Westinghouse for use in Ukraine's VVER reactors. Now Framatome, majority owner of the French state-owned corporation EDF, is also stepping in to replace part of Rosatom's market share. Rosatom and EDF operate a similar business model globally, with both companies being state-owned and looking to build reactors domestically and internationally. Both also fabricate fuel for reactors. Additionally, Rosatom owns uranium mining interests in Russia and other parts of the world, while the French government holds a significant stake in Orano, a major uranium miner. The competition between Rosatom and EDF extends beyond profit. They vie for international influence, alliances, and prestige. Orano's half-year results show resilience despite challenges in Niger. The company's revenue for the first half of 2024 stands at €2,272,000,000, a slight decrease of 1% from last year. EBITDA reached €459 million, maintaining a margin of 20.2%. However, operating income dropped significantly to €12 million from €260 million in the first half of 2023 due to deteriorating situations in Niger affecting the mining sector. Net losses attributable to the parent fell to €133 million, down from a €117 million profit the previous year. Adjusted net losses also saw a decline to €162 million from €45 million. Despite these setbacks, Orano confirmed its 2024 financial outlook. The company projects stable revenues of around €4.8 billion, an EBITDA to revenue rate of between 22 and 24%, and positive net cash flow. Orano's CEO, Nicholas Mays, stated that the company is on track with its development goals. He noted the impact of geopolitical issues in Niger, but affirmed Orano's commitment to meeting customer needs, reducing debt, and investing in future projects. The company continues to focus on decarbonization, health, and energy sovereignty, contributing to the construction of tomorrow's nuclear industry and developing new activities in nuclear medicine and the battery value chain. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by PurePoint Uranium Group. PurePoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with some of the largest uranium suppliers worldwide. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.